Let's start with a question that most people never stop to ask. If buying a house is such a powerful wealth building strategy, why are so many homeowners in America financially stressed? Because what you are being sold is not just a house, it is a narrative, a deeply embedded belief that owning a home is the ultimate symbol of success, stability, and adulthood. The American dream, a house, a lawn, a white picket fence. It sounds safe. It sounds aspirational. It sounds like the finish line. But beneath that narrative lies a system designed not to make you free, but to make you financially committed for decades. Here's the uncomfortable truth. When you buy a house in America, you are not just buying property. You are entering into one of the largest debt contracts of your life. The average mortgage lasts 30 years. That is not a purchase. That is a long-term financial obligation that shapes your entire life. Your career choices, your mobility, your risk-taking ability, everything becomes tied to your ability to keep making monthly payments. And those payments are not small. With rising interest rates, inflated home prices, and additional costs like property taxes, insurance, and maintenance, the real cost of owning a home is far higher than what is advertised. What starts as a $400,000 house can easily turn into a $700,000 total payment over time when interest is included. But this is rarely framed clearly because the system benefits when you focus only on the monthly payment, not the total cost. This is where the trap begins. Because psychologically, a mortgage feels manageable. It's just like rent, people say. But it is not like rent. Rent is a flexible expense. A mortgage is a fixed obligation backed by legal consequences. If you stop paying rent, you may have to move. If you stop paying your mortgage, you risk foreclosure, losing the house and the equity you've built. During the 2008 financial crisis, millions of Americans learned this the hard way. They bought homes they believed were safe investments only to watch prices collapse and their mortgages exceed the value of their homes. This is known as being underwater. Imagine owing $300,000 on a house that is now worth $200,000. You cannot sell without taking a loss. You cannot easily leave. You are stuck. And yet, despite this history, the narrative continues. Because the system is designed to keep it alive, banks profit from interest, real estate agents profit from transactions, developers profit from demand. The entire ecosystem benefits when you believe that buying a home is always the right decision. Very few people in that ecosystem are incentivized to tell you when it is not. There is also a deeper psychological layer at play. Ownership creates emotional attachment. Once you buy a house, it stops being just a financial asset and becomes part of your identity. This makes it harder to make rational decisions. People hold on to losing properties because it's their home, even when the numbers no longer make sense. And then there's inflation, the silent factor that distorts everything. Yes, home prices tend to rise over long periods, but so do costs. Property taxes increase. Maintenance becomes more expensive. Insurance premiums rise, especially in areas prone to natural disasters. What looks like an appreciating asset on paper can become a cash drain in reality. The biggest misconception is this, that a house is always an investment. It is not. A primary residence is, first and foremost, a consumption expense. It is a place to live. It does not generate income. It requires continuous spending, and its profitability depends on market conditions that you cannot control. None of this means buying a house is always wrong. But it does mean that the decision is far more complex and far more risky than the simple narrative suggests. The American dream is not a lie, but it is incomplete. And when you only see half the picture, you walk straight into the trap. Here's a statement that sounds extreme, but is technically accurate. In America, most homeowners do not truly own their homes, at least not for a very long time. If you have a mortgage, the bank has a legal claim on your property. You are making payments, but until the loan is fully paid off, ownership is conditional. This means that for 15, 20, or 30 years, you are effectively in a partnership with a financial institution, one where the consequences of failure fall entirely on you. Miss enough payments and the bank can take the house. This is not theoretical. It is written into the contract. And even after you pay off your mortgage, the obligations do not end. Property taxes are a permanent feature of homeownership in America. You are required to pay them every year, indefinitely. If you fail to do so, the government has the authority to place a lien on your property and eventually seize it. In other words, even if you own your house outright, you still have to keep paying to keep it. This creates a system where ownership is never absolute. Then there is maintenance, the hidden, ongoing cost that most people underestimate. Roof repairs, plumbing issues, electrical problems, HVAC replacements. These are not rare events. They are inevitable over time, and they are expensive. A single major repair can cost thousands, sometimes tens of thousands of dollars. Unlike renting, where these costs are typically handled by a landlord, homeowners absorb all of them. This turns your home into a financial responsibility that never really stops demanding money. Insurance adds another layer. In certain parts of the U.S., especially areas prone to hurricanes, floods, or wildfires, insurance premiums have risen dramatically. In some cases, insurance companies are pulling out entirely, leaving homeowners with limited and expensive options. Without insurance, you are exposed to catastrophic risk. With it, you face increasing costs. This is where the illusion of stability begins to crack. Because while homeownership is marketed as security, it actually introduces multiple layers of financial vulnerability. You are tied to one location. You are exposed to local economic conditions. If your area declines due to job loss, crime, or environmental issues, your property value can drop, and your ability to move becomes limited. Mobility is one of the most underrated forms of financial power. When you rent, you can leave. You can move for better opportunities, lower costs, or a higher quality of life. When you own a home, especially with a mortgage, moving becomes complicated. You have to sell, deal with market conditions, and pay transaction costs, and potentially take a loss. This reduces flexibility at exactly the time when flexibility matters most. There is also a concept known as opportunity cost, what you give up by choosing one option over another. The money tied up in a house, down payment, closing costs, monthly payments, could potentially be invested elsewhere. Stocks, businesses, or other assets that generate income and grow over time. Instead, that capital is locked into a non-liquid asset that may or may not appreciate significantly after accounting for all costs. Again, the point is not that homeownership is always bad. It is that the true costs and structure are rarely explained honestly. Because once you understand that you don't fully own your house and that the system continues to extract money from you even after purchase, the idea of security starts to look very different. And that is exactly what most people are never told. There is a belief so widely accepted that most people never question it. Real estate always goes up. It sounds reasonable. Land is limited. Population grows. Demand increases. Therefore, prices rise. Over the long term, this has often been true. But the problem is not the long term. The problem is what happens in between. Because real estate does not move in a straight line. It moves in cycles, and those cycles can be brutal. The 2008 financial crisis is the most obvious example. Home prices in the United States fell by nearly 30% nationally. Millions of homeowners lost their properties. Entire neighborhoods were filled with foreclosures. What was once considered a safe investment turned into a source of massive financial loss. But here's what makes this more dangerous. Most people believe that was a one-time event. It was not. Real estate bubbles have occurred repeatedly throughout history. They are driven by factors like easy credit and speculation. When those factors reverse, the market corrects, often violently. Even outside of major crashes, real estate can underperform in ways people do not expect. When you factor in inflation, maintenance, taxes, and fees, the real return on a primary residence can be much lower. Selling a house involves agent commissions, closing costs, and repairs, often totaling 6 to 10% of the sale price. This means your property has to appreciate significantly just to break even, and then there's time. Real estate is an illiquid asset. You cannot sell it instantly. In a declining market, it may take months to find a buyer. During that time, you are still paying mortgage, taxes, and maintenance. This creates a difficult situation to exit. There is also geographic risk. Real estate is local. A booming market in one city does not guarantee the same in another. Economic shifts, job market changes, population trends, all of these can impact property values locally. For example, cities that were once thriving can decline due to industry changes or remote work trends. Climate risks can make some regions less desirable over time. These are not hypothetical risks. They are happening. The idea that real estate is always safe comes from looking at broad averages. But individuals do not experience averages. They experience specific markets at specific times. Buying at the wrong time can turn a safe investment into a long-term burden. And yet, the narrative remains unchanged. Because it is simple, it is comforting, and it keeps the system moving. But reality is more complex. If you do not understand that complexity, you are not investing. You are participating in a system you do not fully see. The final layer of the trap is not getting in. It is getting out. Because buying a house is easy compared to selling one under pressure. When you purchase a home, the process is structured, supported, and encouraged. There are agents, lenders, and incentives guiding you every step of the way. But when you need to exit, especially in a difficult market, the experience changes completely. You are now dependent on demand. If buyers are scarce, interest rates are high, or the economy is weak, selling becomes challenging. You may have to reduce your price, wait for extended periods, or make costly improvements just to attract buyers. And all the while, your expenses continue. This creates a form of financial pressure that many homeowners underestimate. You cannot simply walk away without consequences. Selling at a loss means losing. Holding onto the property means ongoing costs. Renting it out comes with its own risks and responsibilities. There is no easy exit. This is what turns a house from an asset into a trap under certain conditions. There is also an emotional factor. Selling a home is not just a financial decision. It is a personal one. Memories, attachment, and identity get involved. This makes it harder to make rational choices when the market is unfavorable. People hold on longer than they should. They hope for prices to recover. They delay decisions. And sometimes that delay makes the financial outcome worse. Then there are external factors you cannot control. Interest rates, economic conditions, policy changes, all influence the market. A sudden increase in interest rates can reduce buyer affordability, lowering demand and putting downward pressure on prices. You could do everything right and still face challenges when trying to exit. This is the part of the system that is rarely discussed because it is not part of the sales narrative. Buying is marketed. Selling under pressure is experienced. And the gap between those two realities is where the trap exists. The truth is simple, but not comfortable. A house can be a good decision, a neutral one, or a bad one, depending on timing, financial structure, location, and personal circumstances. But it is not automatically a path to wealth, and it is definitely not risk-free. The people who benefit are those who understand both sides before they enter. Because once you are in, your options become limited, and that is what nobody tells you.